Good morning, and welcome to the Energy Perspectives Group webinar, hosted by Silvercrest Metals. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Hi, everybody, and welcome. I'm glad to see that oil prices are up today for all of us. So I know you guys are excited about that the last 2 days. Anyway, Silvercrest Metals is hosting this webinar today, and this is the second time they've hosted a webinar for us, and they have made a lot of progress. They are just weeks away from being able to open up their mine down in Mexico. So our speaker today is Christopher Ritchie. He's the president of Silvercrest Metals. Chris is a financial markets professional with over 15 years of experience in resource-based capital markets, including investment banking, marketing, corporate strategy, and risk management. He earned a BA from Miami University in Ohio in 1997 and finished his MBA in finance in the year 2000. Mr. Ritchie began his career with 3 years in risk management at Marsh & McLennan and Liberty International before he moved into trading and institutional equity sales at UBS, Canaccord Financial, and National Bank Financial. During the past 8 years, he, through his connections at National Bank Financial and Canaccord Genuity, he has been a key financial advisor and partner to the previous and current Silvercrest teams through the development of their Santa Lena mine and the sale of Silvercrest mines to First Majestic Silver Corp a few years ago, and 3 financings for the current company, Silvercrest Metals. So now I am going to turn over the controls over to Chris for an update on Silvercrest Las Quispes silver mine in Mexico. I know I mispronounced that probably, which is very close to ramping up to commercial production. So it's all yours, Chris.
Excellent. Well, thanks for the intro, Dan. I appreciate it, and I appreciate everyone attending today. And I'll kind of layer in some oil and gas analogies here, just to maybe bridge the gap between people who've spent a little less time in mining. A couple of the big ones to think about are, if anyone's close to the oil and gas side, is that CapEx in oil and gas is on 15-year lows. I mean, we all know valuations are pretty depressed. Free cash flow yields are high. You're seeing it easier for companies to go buy back their own stock than it is to bring on new production. And that's either through policy, ESG, lack of access to capital or outside capital. So the oil and gas companies are needing to be fully self-reliant. And an interesting data point I saw yesterday was, Jeff Curry, he's the head of Goldman Sachs commodity desk. He was saying that Europe has spent $3.8 trillion. And I love how we just throw trillions around these days like they're nothing. $3.8 trillion, and I can't remember the year, might be last 10 years or so, in renewable energy in Europe. And their reliance on fossil fuels has gone from 82% to 81%. So this idea that we don't have to like mining, we don't have to like energy and fossil fuels, and that somehow the world's going to get by without these key commodities, I'll call it a reckoning, is part of our business model, and we roll that into it. But it's certainly part of the dynamic we're seeing today. For metals and mining, we're pretty similar in that the CapEx we're seeing today is on 15, 20-year lows, and we'll show that chart there. It shows about 20-year lows as it relates to GDP. So the analogy I would say there is, silver today is about $21. 3 days ago, it was at about 18, 19. For most silver producers, their operating costs, so again, that's just their day-to-day costs, not the cost to build the mine, not all the costs leading up to the decision to contemplate to build the mine. Their operating costs are in and around the same price. So, unless prices go higher, it's a big head scratcher as to why someone would go build something and just to operate it at break even. Like, it just doesn't make sense. But what you're seeing here is exactly what that means for companies, right? So we need copper, we need silver and gold, we need nickel, we need cobalt, we need all these things to transition to a cleaner economy, or we just need them for just average everyday usage. But nobody or very few people have the actual incentive to go spend that money. The analogy I use, it's like building a hotel that's got a 10-year life to it, and you're breaking even on the operating costs, but then you go build another hotel. Like, it's just, there's no incentive to do that. So we're sitting there today in this situation for mining where inflation, low commodity prices, and the risks to build are significant. And the time it takes, and this is where energy and mining differentiates a little bit, or significantly, I would say, it takes about 20 years to go from getting a property, drilling it off, permitting it, moving it forward, building it before you get production. So even if we start to see prices significantly increase, it's still going to be 5, 6, 7, 8 years before you start to see new supply hit the market. So, what you're seeing there in this chart here is, if you think about 2008, right before that big crash, China was going crazy. Everyone was moving from the country to the city. Oil prices were high, copper, gold, silver, nickel, everything was high. Every company was able to get financed, right? Every company's project looked good at those commodity prices. All those projects got their money. All those projects started building, and they're all in production. And the typical mine is kind of 10 to 15 years long. So that tells you, if 2007, 2008, or even 13, that all that money's been spent. And if the typical mine is, like I said, 10, 15 years long, that just shows you when we hit 2024, we're hitting sort of a period of time here where we're starting to run low. Right. So again, Silvercrest, and all of this has been a bit of a prelude again to how we are running our business and the type of investment we're contemplating or putting in front of you today. And that is basically to create an investment vehicle that can wait for prices to go higher and manage risk like crazy. And all of that's possible because of the type of asset, and we'll talk about it today. But the starting point of where we're at is we're done construction. All the risk associated with getting a project to the point where it's economic or not, we're done. We built it on schedule or ahead of schedule and under budget. So that's a huge positive pat on the back for our operations team. And the way we financed it, you'll see there in the third bullet point, we've got 100 million US of cash and 90 million of debt. So we're in the process of refinancing our debt to make it basically like a line of credit. And if that's the case, we can throw a big chunk of our cash towards it, have that line of credit available, and we're more or less debt-free, right? So debt-free before we've even started production. So we assumed when we were financing this company that everything that could go wrong would go wrong. And that, as you can imagine, building during COVID was a really big laundry list. And that laundry list, none of it went against us. So, knock on wood, but that's why we're sitting in a really strong position. So right now we're ramping up the mine, which means, ironing out the wrinkles, making sure things work properly, testing certain things, quality control, with the idea of being at full run rate starting in January. So we're just kind of working through that process right now. And in mining, there's a thing called commercial production, and it's a self-declaration. And what you're basically saying is you're roughly within 80% of what the nameplate should be. So you've got enough confidence that how the mine is operating, how you're able to deliver tons from the mill, and then how you're able to recover the appropriate percentage of metal from the rock that you anticipated. All three of those things are working well. So when you're within 80% of that range and you feel good about it, that's usually when you declare commercial production. So we're hoping that's going to be a 2022 event. And that usually coincides with us being able to get that new debt facility. So again, things are moving pretty quickly. And we haven't been marketing very much because up until now, there's just a lot of risk, a lot of uncertainty. So we've just been sort of riding it out and, just getting in a position where we can, have calls like we are today to showcase what we have going forward. So one of the key things you'll see here is that asymmetric risk reward. Now, we put out a technical report about a year and a half ago that sort of talked about our production, talked about our costs, and we're going to update that number, and that updated number is going to come out in Q2 next year. And in that number, we're going to have a new mine plan. We're going to use the new data from drilling. We're going to have new costs and production profile. So I don't know the specific numbers on that, and I can sort of give you a sense of the things that will go into those numbers to give you a flavor for where we're trending. So in our last report, our total cost per ounce of silver on a mining basis was going to be about $7. You can see that in the middle column here. It says cost and it has all-in sustaining costs. That's an operating number. So that does not include your capital, your exploration, your G&A. So that says it's about $668. So those numbers are going to be about 2 years old. So we're going to have some inflation on that. And then if there's any changes on the asset level, we have to incorporate that as well. So we have yet to even turn over the drilling to update, what we have in the ground to the engineers. And the engineers need about 7 months to come up with the new numbers. So I'm trying to scare people a little bit. I'm trying to give them a sense that if we end up coming in at 10, 11 bucks or something like that, that would still put us in the bottom decile. So probably the bottom 10% of silver producers today. So I would rather people kind of got their head wrapped around that and knowing that our peer group is breaking even today. And even if our costs come in a lot higher through inflation or other challenges, that we should still be making very significant free cash flow while the rest of the industry is in big trouble. So that whole trend we talked about at the beginning, where we need to see prices go way higher before someone is able to move a project forward, or imagine being the board of directors scratching your head saying, you want us to approve a project that's barely break even on an operating cost basis, but you have to spend an extra $300, $400, $500, $600 million in capital that will never get repaid. So the fact that we're able to make significant free cash flow today, while other people are not, we should be able to participate in a very healthy way when those prices go up. And that's a big part of what we're trying to create. We're trying to create less risk for investors to get exposure to the upside. For the last 14 years or so, when the Fed has jumped in to protect the markets, it's made everybody make a lot of money. It's made everybody ignore risk. It's made everybody use leverage because they felt as if there was a permanent backstop on every trade they did. And one of the scariest data points I've heard that I keep repeating is that in 2021, more money went into the stock market than the previous 19 years combined. So to me, it's that mentality of the average person out there just chasing returns and ignoring risk that puts us in a position today where interest rates are up, inflation's up, the US dollar's up, oil's up. Those are all conditions for pretty significant market downturns. Right. And that's all those data points are kind of well spoken by economists and whatnot. And those specific ones were from Stanley Druckenmiller, who said that in the following year, earnings tend to drop 35% when you have those conditions take place. So again, I'll go back to say we're more or less debt free before we even start production. We're going to have extremely low costs relative to our peers. The risk associated with getting an asset to a construction decision, let alone through construction, are behind us. And the incentives for anyone to bring new supply online still don't exist. So the key thing that we're trying to create for investors is we can stay in the trade. I expect a fair bit of volatility in the next few years, whether it's from more interest rate hikes because the Fed believes that inflation is more damaging than a recession and they have to get that under control, or people that have borrowed too much and their wealth effect is taking a big hit and the economy takes a downturn. If that last point is accurate, there's a lot of data out in the market to suggest that the market valuation relative to commodities specifically, so if you're thinking of asset classes of what you're personally exposed to, that market, financial assets, are probably within, a top few percentile of all time relative to commodities, meaning commodities have rarely been this cheap. So if they're still this cheap, but there's no incentive to build new projects, and there's a heck of a lot of risk if someone does build the new projects, it's the in production assets that are safer plays, right? Because again, they have less risk and they can capture the upside of the commodity price if and when it starts moving. To give you a little flavor on that, we've had a pretty big move in silver in the last few days. We had about 9 million shares that were short, meaning people were betting on our price going down. And when the Fed was raising rates, there's a lot of people who assumed that, commodities would get hit as the US dollar rose. And that played out very significantly. I think those traders made a lot of money in the last 6 months or so. But in the last couple of days, you saw the Bank of England, cause some financial stress by putting some tax breaks in. And the market said, well, who's going to pay for these tax breaks? And they took it out on the treasury market, which caused some serious margin calls, or were about to before the bank had to step in. So they capitulated. And I think what that sent a message to the broader market was, when is the Fed going to have to pause, that the damage that their interest rate hikes are doing now need to be weighed in the broader context? Typically, you need interest rates to go much higher than inflation rates to actually cut inflation, and we're nowhere near that. So if we do keep seeing a rise in rates, that means financial assets are more at risk, which means commodities tend to do quite well. So we've rarely seen commodities this cheap. And we have an asset that is extremely rare in the margins plus the financial health. So that's kind of the, what we've been very fortunate to do, but also very lucky to have an asset of this quality and the technical team that's been able to execute on that. So you want to go to the next one there, please, Lindsay? So in order to kind of understand where we're at here, we're trying to get the commissioning underway. And we put a news release out a couple of weeks ago before we went to a big conference, just so we could chit chat with everybody about the details. And as discussed, there's three main components of a mining project. One is the mine itself. Can you get enough material from the underground to fill the mill? Okay. Now, for us, we've got a bit of an ace in the hole. And what that is that we've actually already been mining for about 3.5 years. And we've been mining, and we've been putting that material on the ground to create some stockpiles. So one of the key pressures that all operations face is just continuously getting enough tons to the mill. And we're working on that, we're ramping on that. But these stockpiles allow us to take a little bit of pressure off of that and get enough tons to the mill for the mine life. And you can see from this chart here that the dark blue is the percentage of material coming from the stockpiles going into the plant. So in 2022, about 70% of the material is coming from the stockpile. 2023, it's about 30%. 2024, it's about 20%. So when we do the new mine plan, we need to say, okay, let's make sure that whatever mining rate, meaning the tons per day coming from the underground, is safe and consistent and repeatable. And then we can use these stockpiles to supplement what we're doing. But we can also have a bit of insurance, right? It'd be really nice to know if you had some challenges underground or in any area that you just had a bit of insurance. Quite often mines just get under pressure trying to deliver those tons, and it's just not great. So again, we have the strategic, financial, and margin flexibility to create this new mine plan in such a way that we can operate it efficiently. And that's going to be the big plan. One of the other two key areas is the plant itself. And our COO, he's a bit of a rock star. He built this project on time, on budget, and there was no change orders. So anyone here who's built a house and they know what the cost is when you start to change things around. So you have a $140 million project with no change orders during COVID, with supply chain challenges, challenges to get labor. So that's well underway. And so far, the plant is running as per schedule, right? We're slowly increasing the tonnage, trying to make sure it can handle it, stress testing the components, stopping here and there to fix little things. But so far, we're ahead of where we thought we would be at this time. The third key area, it's a term called recoveries. And what that means is you've got gold and silver within the rock, and are you getting all of that gold and silver out, or what you're expecting to get out? And in our studies, we thought we were going to have in the neighborhood of 94, 95%. And that's a bit of a secret recipe of how to actually to get those numbers. And we thought that today, during the ramp up, we'd be about 75, 80%. And then sort of by January, we would be closer to that, over 90%. We're already over 90%. So I would say if you take those three categories, the recoveries are going well, the plant is going really well, the mining rate is a little slower, but we've got the stockpiles to supplement that. So those are, and then when you combine that with the balance sheet, we're basically just heading out into the market today with commodity prices starting to get a little support, with the long-term supply and demand story fantastic. And the concept, again, of even why gold and silver is relevant here, those things are all in front of us. So some of the key data points for why gold and silver are even worthwhile investments, instead of talking about the mumbo jumbo of a mine, is from 1965 to 2015, the US government increased the supply of dollars by 6.7% per year. So you kind of needed to earn your money, pay your taxes, earn about, probably 10% a year plus just to keep even, right, with the new supply of dollars. But since COVID, we've increased the money supply by 41% in the last 2.5 years. That's a staggering amount. We've kind of gotten to the point where we're destroying the purchasing power of the dollar. And these charts here are worth a look. And the one that I think is probably best to look at is the one on the top left. And it's my way of sort of describing the power of gold and silver versus the dollar. Because again, 88% of all transactions in the world take place in the US dollar. Everyone's used to it. We use that as our base case currency. So if you look at housing prices in dollar terms, that's the green line. You can see they went a little bit over $100,000 per home in 1990 to over 400,000. So you got about a 4x increase in home price if you're using dollars as your currency. If you look at housing prices, in gold terms, housing prices are actually slightly down. So what that means is gold is a better store of value than the dollar, right? If you had sort of taken your earnings, put it in gold, you're protecting yourself against the money printing that's going on. Oil has a similar trajectory. I mean, right now, if you priced oil in dollars, you're about $20 a barrel to $80 a barrel in the last 30 years. And if you price it in gold, you went from about, $50, and right now you're at about $40. So again, filling your car and running a business and consuming energy, you've actually saved money if you had hold your wealth in gold. And the bottom right, you can do the same thing in copper. So when you think about building a mine going forward, labor, copper, oil, steel, all these charts are the exact same. So when you think about, bringing on new supply, you're going to have higher and higher costs because of what the governments around the world have done with money printing. So, this inflationary trend impacts companies building assets, right? Because the cost to build it, you're exposed to all of these things. So the fact that we're already built, we are protected against that specific risk for quite some time. So that's the big difference between buying a exploration company, which can be really sexy and fun. And we were definitely in that category when we came out of the gates. And then a development company, which is like, buckle in, you've got to execute on a lot of different factors here. To now where you have your operating costs and where the commodity price is. And again, I'm not trying to trivialize the risk of operating a mine, but it's a big step down from finding a commercial asset to building a commercial asset on top of that. So again, for us to be in a position right now where we're clean on the balance sheet, should have very healthy margins, significant risks are behind us, and the very long-term trends are that gold and silver have never been more important. Commodities have never been cheaper, or rarely have been cheaper relative to financial assets. And no one's out there building projects because the risk to do so is just too high. So we're trying to, again, provide a vehicle where if gold and silver go lower, we're still making good money. We do our internal budgeting using $14 silver and $1,400 gold. And again, if our costs, come up to 10, 11, 12 bucks, we're still making significant free cash flow while everybody else is dying. So if we don't see prices go higher, we're going to slowly or quickly run out of supply of all the things we need, to build electric vehicles, to build solar panels, to build wind turbines, to build electricity grids, electrify your homes. And all that demand picture is going through the roof, but we seem as a world and a financial market to hate the companies that are going to get those things. So that disconnect is actually creating a better and better opportunity for those that position themselves well in that dynamic. So that's kind of giving you a little bit of the technical stuff, hopefully a lot of the big picture and how we think about, managing a company and trying to be safe through the craziness and still put ourselves in a really good position to make our shareholders a lot of money. I think that's probably okay on the presentation side and get on to the questions. I see one question on the chat there, and then I'll turn it over to you, Dan. For the recoveries, and the question was, what are you seeing on recoveries now and whatnot? And what we're seeing there on the recoveries is we were thinking we were going to be at about 75–80% today, but we're already trending at the levels we expected at full run rate. So I would say recoveries right now we're extremely pleased with what we're seeing.
Yeah, that's good. Okay, I'm back on with you. Just reminder to everybody, if you have a question, just go to the bottom of your screen, open the chat box and type it in there, and then we'll get to that. I was emailed several questions, so I want to get to several of these first, and then we'll go through the chat room. But I want to remind everybody that this is the management team that monetized Silvercrest Mines with the sale of that company to First Majestic that led to the spin out of what is now Silvercrest and trades as SILV. So Chris, can you tell us, are there potential suitors now for this current mine?
So I'll give you, I'll kind of go back to the macro perspective. When you build a mine, you have to find it. You have to either buy the asset, you have to explore it. And to give you an example, we've probably spent about $130 million on exploration. You've got to permit it. You've got to prepare the property for all that work. And then you have to pay for the capital, right? And then you have to pay for the operating costs. So when you see an economic study, it's called a feasibility study. And that's usually the last moment in time where you put it in front of your board of directors, you put it in front of the investors, and then you try to go raise the capital. That number you see in terms of capital is always from that moment in time going forward. It basically erases all of the money spent before that. So when you're thinking of a break even, those economics are only trying to show the economics assuming future capital. So it's very misleading. And my point in saying that for M&A is that, to buy a Silvercrest, if someone wanted to come in and buy us, that you're getting good margins. That you're getting an asset already in production. You're getting a good balance sheet. If they were to go build an asset from scratch, they don't know if they're going to get a viable project. They don't know if they can execute it on time and on budget. They don't know if they have the capital to do it. So for us looking at the strategic value of this asset, it's far, far, far easier for someone to build something in production, to buy something that's in production than to start from scratch. So I can't obviously specifically comment on M&A, but if someone came to us and said, hey, how about we do a merger of equals? And again, that's if someone wanted to buy us and it's no premium, I would rather say, all right, go get your own asset. Go build it yourself. Right. So it's the strategic value today of an in-production asset that has a known entity. We're a known high margin project, which is extremely rare. Even if you think about other assets, why would someone else go buy an asset that's break even?
Right.
But at the same time, everybody's got, a ticking clock. And that ticking clock is, all right, I've got 8 years of mine life left, and it goes to 7, and it goes to 6, it goes to 5. I'm not making any money today. My bank account's running low. How am I going to go build my next project? Mm-hmm. And that's the dynamic that more and more capital we believe will flow to the assets that can ride out this storm and participate in a healthy way. And that includes the strategic value of someone contemplating buying an asset like ours versus starting from scratch on their own.
Yeah, right. I mean, it's equivalent to, if I went out and spent $250 million building an oil field and drilled 20 horizontal wells, and now they're all cash flowing. If you come to me to buy it, you're gonna have to pay me more than what I've got sunk into the project to make me want to sell it, unless I, just desperate for cash or something. But anyway, we're starting to see more M&A on the oil and gas side. I'll tell you that. I think you answered a lot of these questions, but I'll quickly go through them. You said one is when do you expect the mine to open? Well, it's pretty much already open, right? You're just ramping up.
Yep. If Lindsay goes back to the first slide in the presentation, you'll see our first silver and gold bar. And again, we're 55% silver and 45% gold.
Oh, okay.
So there's our 0.00001. So that's those bars are at about $350,000 worth, right? So that contains gold, it contains silver. One of the other questions was about security and whatnot. So the way it works is we mine it. We mine a ton of dirt, you pay for a ton of dirt, and then you have your revenue per ton. And we melt it down. And Lindsay had another photo of that. And it comes out in a bar like this. The refinery on the bottom right here, the refinery comes to us. They pick up the metal. They take ownership of it at that point in terms of security, insurance, and whatnot. They transport it to their site. They remelt it down. Any impurities that exist at the mine level, they can separate those out. and then you create specific gold bars and silver bars from there. So again, you know, for us, we get the shipments extremely regularly so that there's not too much at site. But again, that risk is borne by the refining company when they come pick it up.
Okay, but what at this point though, I mean, the mine is actually in production. It's just ramping up to full production in January, you think, but there's no way the government's going to shut down the project or anything like that.
So if you think about it this way, and when you look at our existing mine plan, which we hope to obviously find more ounces and put it into the mine over time, or the plant over time, we're going to pay the Mexican government $303 million US. So that's for the taxes, the royalties, that's the income taxes coming from the 800 people employed. We're in the community right now fixing their sewage systems. They're a big agricultural and ranching community. We're fixing all of their aqueducts, which are gravel, meaning the water goes from the river to 24 kilometers of aqueducts and the water just dissipates and evaporates, which means these guys are extremely vulnerable to climate change and problems. We're fixing all that. So we're going to save the community over 100 times the amount of water that the mine itself uses. The picture on the bottom right, every single day that you're mining, you go into the face of the mine and you sample what you have, and you want to reconcile that with what you think you had, and you can do the mine plan accordingly. That means you have to go test what you have. So that needs a lab. So we built a lab in the community. We spent $2 million. We gave it to the community, a company to run it. There's about 20 employees. Now they'll give us preferential rates on our assays, so we make our money back over time. But we're creating a long-term business in the community that, you know, works outside of us. So, you know, for the Mexican government to come in and say, not only are we shutting you down, but we're basically sending a message loud and clear that, you know, rural employment in Mexico is now dead as it relates to mining. It's always possible, but I would argue when you talk about political risk, I would say political risk is much higher in the United States and Canada as it relates to permitting projects, you know, getting financing. In Canada, we can't even approve pipelines, right? You know, so, you know, political risk has different categories associated with it. In Mexico, permitting is extremely fast, labor is extremely cheap and high quality, and the Mexican government needs us.
Yeah, oh yeah, yeah, I know. I just got back from Mexico, and I tell you, they need good jobs down there. That's for sure. You got a lot of poor people, but you know, I used to think that all this geopolitical risk, you were talking about third world countries or Middle East, North Africa. Well, now you're talking about the U.S. and Canada being anti-mining, you know, oil and gas business.
Well, they
It's
are.
crazy.
They absolutely are. And I mean, if you think of the money you spend every year as a company, your management team, your offices, your overhead, every year it takes you to not bring an asset into production, you're just accumulating costs. You know, like I said, we took 7 years to go from first drill hole to production. The average mine is 20. And that's because we knew it was highly economic from day one, maybe not day one, but very early on. So we were able to do a lot of things in parallel as opposed to sequentially. So if you think about, you know, our G&A, next year, our G&A is probably about 17, 18 million bucks. In the early days, it's much less. But if you were to even assume it's 10, you know, 10 times another 13 years, that's 130 million wasted dollars on time.
Yeah, right. Right. There's several questions that I got about inflation and how that impacting. Well, you're way past that on the construction part. So now it would just be like operating expense inflation, correct? Like you said, it might go from, you know, about $7 an ounce OPEX to as much as $10 an ounce OPEX compared to the current silver price of $21. So,
well, maybe more. Might just to clarify, I don't know that number yet, but I mean,
okay,
when I think of inflation, you know, our labor costs are going to go up.
Right.
Right. So that's a definite thing. We are on the power grid. One of the other questions was, is your power up and running? So we're using diesel up until a few weeks ago, but we have an 87 kilometer pipeline sorry, the pipeline, the power line.
Line. Okay.
That we built 2/3 of it. The Mexican government is refurbishing 1/3 of it. They're right on the tag end of that. It's been a pretty painful process, to be honest. So we're fully using the power line right now, but it's a little less reliable. And that's because we're using a small little Band-Aid solution for a portion of that power line right now. And that Band-Aid is going to get ripped off, we think, by the end of the year to increase that reliability. But the way I phrase it to investors is we already decommissioned the diesel generators. So it gives you a sense that our confidence is there that what we have right now is certainly sufficient. And that as we improve that by the end of the year, we're going to be extremely confident that the power is not only cleaner, but more reliable.
Yeah. Is water a problem?
Yeah, this is what's fascinating. So there's a thing called, and it's ESG is an interesting topic. And I think in many ways it's fantastic that it's coming and it's out there. I think it's a lot of the energy around ESG is extremely misplaced. And there's a lot of well-placed energy around it. And we siphon through the BS, and what we focused on is water, actually. Mm-hmm. And there's a thing called TCFD, and what that stands for, it's the Task Force for Climate-Related Financial Disclosures. And I'll give you a good example of water. Imagine if you were going to find a new project and you spent 10 years getting it forward, and then you were doing a permit for it, and then you realize that the mine's going to consume a lot of water. I got a little condo alarm here, so if that's bouncing around.
No, that's okay. Yeah, I heard it, but it's no big deal.
I think it stopped. So what we did with water is we realized if you go into a community and they're highly reliant on water and you're seen as competing for water with them, mm-hmm. you're asking for trouble when it comes to social license, political risk, and just permitting risk. So our area is quite vulnerable to water because, again, they're ranching and farming. And instead of seeing that as a risk, we saw it as an opportunity. So that's why we went in and did this work, went to the community, went to the government, talked to the head of the agricultural agency, the head of the water agency, the mining director for the state. I had dinner with them a week and a half ago in Mexico. And we said, we noticed there's a problem. We want to support the farmers and ranchers. We want to help you fix the infrastructure in the area. We're committing to a 5-year plan. And that's where that number I stated, that we're going to end up saving the community over 100 times the amount of water that the mine itself uses, because mining uses less than 1% of water in Mexico. Agriculture uses 74%.
Oh yeah, yeah.
So these are things, if you go into a mining community or any community, if you don't have, or you're not going to be part of the solution for some of the problems going forward, you're going to run into problems. So this is just part of being a good business. And it's just part of managing risk. So I don't even think of it as ESG, right? It's just how do you be a good steward, right? How do you be a good partner?
Yeah, you don't want to be fighting with the local village people, I would say, right? You want to be providing good paying jobs and helping their standard of living.
Absolutely, and mining's the highest paying industry in Mexico,
yeah.
Right? The town we're in is called Arizpe. It was actually the historic mining capital of Mexico.
Really?
So
okay.
They have National Miners Day. So again, in Canada, it's kind of a vilified, maybe not Canada, but in the West, I would say it's kind of a vilified industry. But in Mexico, it's extremely celebrated. It's high paying. It's something they respect. But yeah, you absolutely have to be a good partner in these communities. And we did that with COVID as well. We have people working 2 weeks on, 1 week off, going home to their families. If we had them all coming back through the community, there was a risk that, the community would be exposed to the frequent traveling of our employee base. And we said, okay, let's just build a camp. We built an isolated camp on the site, 500 units. There's the photo there. So people would go to the major city nearby, they would test and quarantine and get on a bus and go directly to the project. So we didn't expose the community at all because we just didn't want them to feel that we were sort of not respecting their a challenging time. Mm-hmm. So again, all things that are just kind of being good partners that are very much on our radar. And again, our CEO is a rancher. He was a rancher from Montana. And again,
Mhm.
this is a ranching community. So we actually have our own cattle ranch as well. So we've got about 150 head of cattle.
Cool. Now, how many people work full time? And I imagine the plant is a 24/7 operation.
Correct.
And how many people like work on all the shifts?
So in construction, we were about 850
Wow. Okay. I didn't know.
to get up and running. I think we're in the neighborhood of about 500 now. And that's
Okay.
including contractors and miners and whatnot.
Okay. But that's going to be kind of standard going forward for the
That's
plant?
pretty steady state. Yep.
So you got people down in the mine, and it is an underground mine, correct?
It's underground. I don't know if Lindsay, you have any photos there, but I would say it's really close to surface.
But but trucks just go down tunnels, fill up with ore, and then come to the surface.
Yep.
Okay.
Yep. It's this. So for everybody, this is tiny. I mean, this is how the economics, anyone not sure and they're scratching their heads on the economics. And I apologize for this. My condo's playing Christmas bells.
Okay.
Is that when you have a ton of dirt, if you just have more gold and silver in that ton, well, you just got more revenue in that ton. And that's what we're blessed with. So for us, we're not moving a lot of tonnage. So to give you an example, our COO who built this mine, his last mine, they move more tons in a day and a half than we move in a year. Right? It's just our tons are better tons.
Mhm.
So this is a pretty low impact, low footprint operation. You know, so again, we have trucks that go underground. The ore body is about 300 meters underground. If you were standing at the foot of the or the face of the opening for the underground entrance, you know, you could probably walk with me for about 6 minutes before you're getting to the main ore body.
Okay. Okay. Let me, because we've kind of been, you know, we're the energy perspectives group. So we've been looking at companies, mining companies that produce the copper or the nickel or, you know, more. Let's talk about how much is silver used in like solar panels and how much silver is needed for all this, you know, Green New Deal stuff.
So in general, about 60% of silver has an industrial purpose. And that's a little broader than just, you know, energy transition. It's an antimicrobial, it's good for conductivity. It's in a lot of electronics. You know, it is in a lot of solar panels. So it's kind of, if you think about it from a recessionary standpoint, you know, if there is a big recession, it can be a little bit vulnerable on that. So sometimes it moves on that. And then 40% of it or so is on the investment side.
Mm-hmm.
But if you were looking at long-term supply and demand right now, and people who are, you know, big silver bears or bugs, I should say, we're running really low on supply. And again, there just isn't really a lot of incentive to translate this in terms of where most of the supply comes from. About 30% of the silver supply comes from primary silver mines, and about 70% comes from kind of copper, gold, silver mines. So again, you got a ton of dirt. You can have copper in that ton, you can have gold in that ton, you can have silver, whatever's in there. You're just trying to monetize the value of whatever's in each ton, right? Because you have a cost per ton, then there's your revenue, and the revenue can come from whatever's in it.
How much of your revenue? I didn't realize you produce that much gold. How much of your revenues are going to be coming from silver and how much from gold?
We're about 55% silver.
Okay.
Is in the production side of things, and 45% of the production would be the gold.
But
obviously,
on a financial basis, you'd have more revenue from gold.
Yep.
Okay. I didn't realize you had that much gold, so that's cool.
So silver, so the point is like the copper, for example, copper is at around, I don't know, 340 right now, 350, haven't seen it today. But these projects, the capital tends to be way bigger for these big copper projects. So that means the risk is way bigger. And there was a recent report written by the Bank of Nova Scotia that came out and said, you need about $4.50 copper for the next generation of projects to make a 10% return. But that 10% return excludes all of the original capital. It excludes the acquisition cost of the asset.
Right.
the
It's just operating
exploration.
expense. Yeah.
Yeah. So we need a lot. We need a lot higher copper prices before you're going to see the other big amount of silver start to show some ability to come online.
Right. I mean, I say all the time on my podcast about this energy crisis. There is no quick fix. I'm assuming, China gets past COVID, assuming we don't have a nuclear war or something in the next few months with Russia. I don't see any way we're going to be able to ramp up. There's no quick fix for ramping up a bunch of oil production to meet the energy demands we're going to be needing for the rest of this decade. And, I was talking to, one of our copper mining companies that hosted for us. And we were talking, they're going to have to produce more copper in the next 20 years than humans have produced ever in order to meet some of these, lofty goals about replacing fossil fuels. It's just the materials don't exist. And we're not spending nearly enough on exploration and development to meet these lofty goals. So I don't know.
Not to mention, I mean, how many of you in the audience have kids going to become mining engineers?
Right. That's true. Yeah.
You just don't have the talent. So when we talk about inflation and pressures, it's there's a few different ways to look at inflation. There's market-based inflation, and then there's going to be asset level inflation, meaning if there's changes in your, meaning let's say, for example, the grade's lower than we thought, your revenue per ton is less, so that your costs go up on a unit basis, right? But then you're going to have, I call it congestion. So let's say copper went to 450 or tomorrow, gold went to, 2,200, silver went to 25 bucks an ounce. Well, everybody goes to start a new project. Well, now you're
but then where do you get the people? Where do you get the engineers?
Right. Now you're fighting for a limited number of really good engineers, a limited number of contractors, you know what I mean? So all of a sudden that congestion causes inflation, right? Because everyone can say, well, if I'm going to go work in a horrible area, I'm going to charge you 20% more, or, it becomes competition just to get the people.
Oh yeah. Hey, I talked to a lot of oil company CEOs. And they're saying, people are not going into petroleum engineering. People aren't going into the landman programs and stuff because our governments have vilified these industries, and that's going to be a big deal. And I don't know, we're going to need some good people. So.
And that's where that ESG moment needs to shift. We need to sort of, hey, let's look at the solutions of this, and we need more people going into this business.
Yeah. Let me get to a few more of these questions. What is the industry average AISC?
So it's when I mentioned about 30% of silver comes from primary silver mines. The senior silver producers. So when I say that, I'm sort of cherry picking the assets that ended up in the hands of the bigger companies, which means those were the most coveted ones. Those are the ones that made it.
Yeah.
Right. So I'm already being kind by using this as my sample set, because again, there's other assets that have higher costs. They're not as good. They're just in trouble. But the senior ones, the average AISC is over 20 bucks.
What is AISC?
It stands for all in sustaining costs.
Oh, okay.
So that's basically your operating costs. But there's always a bit of funny accounting with some of those where they kind of well, we're going to leave this out. We're going to leave that out.
Yeah.
So if you're looking at this as an investor, make sure you're looking at the company's liquidity. You might have quarters for a company where they say, hey, we had $2 of margin per ounce, but their balance sheet got worse.
Yeah.
Right. So there's other expenditures that go into the day-to-day that they exclude from that particular number.
Right. You got to know what they're.
Now, the other number is, like I said, it's what is the cost of silver coming out of the ground if it's from a big copper, gold, silver project, because the main product might be copper, right? And that's the issue there. So I would say the AISC of those is probably more related to the copper price, right? And that's why I referenced the cost of new projects coming to the market need a much higher price. So a lot of the in production assets right now, I mean, copper, you can be, you know, $2.50, $3 a pound, but that number is trending higher.
What?
And
Well,
that's the difference. I mean, gold, you're just storing it forever. Copper and nickel is getting consumed, so those things need to spike. For silver, a huge chunk of it's being consumed, and the rest is for investment purposes. So again, you're back to the idea that there's really no economic incentive for someone to bring new projects online today. Or if it is, you're kind of like operating like a charity, right? You're building it at a loss so that the supply hits the market, which we don't have, you know, we don't want to do that to our investors.
Yeah. When is Silvercrest, the company, going to be cash flow positive?
I mean, I would expect Q1.
Okay. When the mine is fully operational, and you've got enough cash and line of credit and everything to get you across finish line, I could see.
I mean, a way for us to put that in, we raised $120 million of debt to get us through the build. And our lawyer that we used for this, you know, he lost a bet to us. We're the only company he's ever worked with that didn't actually access or draw all of that debt. Meaning we've got 90 million of debt that we're going to be paying off pretty rapidly, and we've got over 100 million of cash.
Okay.
So again, let's put it this way: our old mine plan had us producing over 11 million ounces next year. So let's take 11 million ounces, and let's say our costs go to $11. Silver's at 21 today. That's $10 of margin.
Okay. But
right?
what? Okay.
So that's over $100 million of cash flow next year, if those numbers are relevant.
Okay. So when you get so your first goal is to pay off your line of credit, your debt.
Yep.
Then are you are projecting, looking out into the future, you're thinking you might start paying dividends or something?
Yeah, these are the why these true costs are so on our mind, because we're trying to figure out, like, you know, if we're selling an ounce at $21, can we go get a new ounce for less than $21? Right? Like, we have to think about that as if we move forward with new projects. You know, dividends, you know, they're great, but they give you you know, they have not the best tax impact. On that side of things. If investors today go look at Centerra Gold and Kinross in the last 3-4 weeks, and Centerra was today, they both announced buybacks. And Centerra is up, I think, about 15%. Kinross was, you know, up, I think, about 20% since then. So I think the market thinks buybacks are more efficient. Because again, remember at the beginning of the chat today, we talked about commodities relative to other asset classes haven't been this divergent in, you know, close to 100 years.
Right.
So I think we're trying to battle with those same conversations. Does it make sense to hold on to some ounces? Does it make sense because silver and gold itself is a good store of value? We definitely want to pay back that debt. We definitely want to have a war chest. And if there's other companies that just can't survive and they have good assets, they can't move forward, the worse the market gets, you know, we want to be opportunistic while everybody else is hurting.
Okay. Well, I could tell you, all the CEOs I talk to they all think their stocks are undervalued. They all do. Because I worked for Hess and I was in business development, and we would look for companies to take over if we could buy them for 6 times, you know, future cash flow. And now I can give you a list of really high quality companies that are free cash flowing, that have a lot of running room, and they're trading for like 3 times cash flow. I mean, just in my mind, it's impossible to believe there's not more people, you know, going after just buying these companies just to take them private or something. It's just the cash flow multiples are insane right now.
Yeah, and the energy side, it's definitely ridiculous. Like I'm very long a lot of energy, and it's free cash. So to me, the metric I want the investors to hone in on is free cash flow. Right. Because you know, you can engineer the numbers where the cash flow looks nice, but if the balance sheet isn't improving and you've got a limited number of years or barrels of oil or ounces of gold and silver, and if you don't have you're not building up a war chest to build the next project, you've got problems. So make sure you're concentrating on free cash flow.
Right. I agree. And all the companies like in our Sweet 16 this year. They're all currently free cash flow positive. So we weren't saying that a couple of years ago. I can tell you that. Hey, how I think we've addressed this on political risk of just a country in Mexico. We had one of our companies, Taos Energy. They were working on an offshore project down there that they were originally named the operator, and then the new government decided they wanted to be the operator and took over the project, and that was kind of a bummer. Do you see anything like that? Any potential of that kind of risk, political risk?
I mean, again, when I think of political risk, I kind of have, there's different buckets, right?
Right.
I mean, there's always the risk of taxes, right? I think across the world right now, we're going to see how that goes. I mean, the UK tried to cut taxes and the market got smoked. So we'll see how that goes. If they make it less inviting for investment in Mexico, because it's all foreign capital that's coming into Mexico to do the mining. I shouldn't say all foreign. It's a significant amount of foreign capital coming in. So, if you make it less appealing, you're going to get less foreign capital. So you'd like to think if there's some degree of logic in politics, let's not hold our breath on that, that would be a dynamic that makes sense. Permitting is extremely fast. I mean, you have 90 days. If you submit to the government and they don't get back to you in 90 days, you're deemed to have gotten the permit for certain things. On the nationalization side, I mean, there's always people within all governments that are anti-oil, anti-mining. I mean, the U.S. Congress pulled all the oil execs, I think in October 21, in front of Congress to berate them for, killing the world. And then, 6 months later, they pulled them back saying,
why are you
producing more oil?
Yeah, I know. I know they got on to Exxon yesterday. Why aren't you producing more? Like Exxon alone could solve the world's energy crisis.
And this is where that ESG comment and the policy comment is getting there. So, I mean, the reliance on the Mexican government from these royalties and taxes and whatnot is very significant. Every government, every new leader can do things. I would be blown away that they would look at a very short-term gain of taking something, for the detriment of huge amounts of labor and huge collective investment process, right? And that's why, again, for the ESG movement, for us, we're amazing corporate citizens in the community, so that, right now, the work we're doing, their dinner we had with, again, the water, agriculture, and mining director, the governor, thinks we're one of the best projects out there. They're pushing for us to partner with them on some of these projects. I mean, because we're the ones doing work that they should be doing. Yeah. And they're getting credit for the partnerships and the capital we're bringing to the table, right? And these local communities are seeing us work with the government. So the government's it's good vote getting for them, right? So we're very aware of these dynamics, and our team's experienced enough to make sure that we do the best we can to just understand the dynamics we're working with.
What is the royalty rate on the mine?
Oh man, there's a income tax, and then there's an EBITDA royalty tax, and I think they add up to about 30% in total.
Okay, but it's not just like a percentage of the silver and gold that comes out of the mine
of revenue. So when we calculate, when I gave you that number of 303 million US, that was all the taxes plus the income taxes and that we remit to the government.
Yeah, well, we have people that shy away from investing in companies in the DJ Basin, which happens to be in Colorado, just because it's a Democrat state, and they think all Democrats are against oil and gas. But then I have to remind them how much revenue the industry pumps into the state of Colorado's treasury, and that's why it's a pretty friendly place to do business. Well, anyway. I think we answered all of Travis's questions. Okay. Since Henry asked, if it's 50% gold, why don't you call it Goldcrest? I don't know, maybe we should.
A couple of things. It's a good question. I mean, one is that the previous company that our CEO started actually was 25 kilometers down the road. And that was called Silvercrest Mines.
Yeah.
So this one's called Silvercrest Metal. So I think there's just a bit of branding
Yeah.
associated with that. And then at the same time, there's less silver companies out there. So I think for the people that are uniquely interested in silver, it's just, again, another aspect of branding. But there's,
Yeah.
it's just we do have more silver, but yeah, not by too much.
But if somebody came and made an offer you couldn't, way above what your costs were and everything, and you sold, could you spin out your other assets just like you did this one into another company and just sell just this mine?
Well, I mean, a good example of that is that when we sold the last project, the market was in the dumps. Silver was at $15 an ounce. And the company First Majestic that bought us, they're high cost. And they needed our cash, they needed our margins, they needed a mine that was economic. They bought us. And the way I actually present it is that we voluntarily sold to them at the very bottom of the market. But if you think about it, we had a $154 million transaction. And that transaction got us 24% of that company. If you look at that market cap today, I think they're over $2 billion.
Oh, wow. Okay.
So we actually used our strength and our margins and our cash balance to take advantage of their vulnerability. And then the 9 months after that transaction, their stock went up 600%.
Mm-hmm.
So our shareholders, I had some people say, you sold too soon. And I was like, no. We got a healthy chunk of a company that had a lot of leverage to the silver price. And that's what our investors got. And we spun out Las Chispas. So our shareholders got this asset for free and they got 600% upside. Now, again, we got a little lucky with the market timing and things like that. So let's not take that too far. But when we think about how we structure our balance sheet and whatnot, and we say that we want the market to get worse and worse, it's because that dynamic exists again, right?
Mm-hmm.
We should be healthier and more resilient. And any negotiations where someone says, hey, let's do a transaction at the bottom, we'll say, well, we don't need you.
See, that's why this is why
puts us in the driver's seat.
Yeah, we're seeing some transactions on the companies we follow closely where they're paying cash plus stock because the sellers see the upside potential in their company. And that's why they're taking a big chunk of the purchase price in stock. So it's definitely a good way to structure deals these days when you believe the whole industry is undervalued like crazy, which I do. So,
well, I mean, that's, for me, I've purchased 750,000 shares, and that's not
good.
Options. That's not other, like, that's me purchasing with my own cash, including, last week. I bought more. I bought another 55,000 shares. So for me, if we do a transaction, it's not me selling, it's me transitioning into another vehicle. Right. So if it makes sense to combine for, you don't need two CEOs or two presidents or two CFOs. You don't need two head offices and whatnot. You can get some synergies that way and get some economies of scale. If there's benefits you can get, if it's another asset that's distressed and you're getting it cheap, or another in production asset that you want to capture the run up in silver without the same issues around building. Those are the bad markets, are when really good assets and good companies can do really well. Yeah.
I agree 100%. I think there's some great opportunities available in both the mining sector and the energy sector, which is why we're bringing some of these mining companies to attention of our members. Anyway, I think we'll end it there. I want to thank you, Chris, for hosting this. Maybe sometime we can get you, when the winter gets real tough up there in Canada, you can come down to because we finally had a quote cold front. So our highs are only in the 80s. I love when they call it a cool front down here, and it's still the high for the next day is 85.
There was some tennis tournament. There was like the Oil Man's tennis tournament I was invited to one year. So maybe I'll come down for that.
Yeah, I could tell you, I used to coach soccer for my kids when they were in high school and stuff like that. And playing soccer down here in the summer, you better be in shape. I can tell you that. It's brutal. All right, man, we will end it there. We'll be watching you. I think some of our members will be investing in Silvercrest, that's for sure. And hopefully we'll get you to Houston sometime. So thanks again. And Sabrina, why don't you end it there? We will be sending out a link to the recorded webinar that will go out to all of our global membership, which is over 400 people. So this is going to get a lot of views. So now would be a good time to buy this stock. Thank you.